It's Brian Preston, the Money Guy.
Okay, Phil has a question. It's going to kick us off. How important is asset location in the accumulation phase when you are still 15 to 20 years away from retirement? Do you just build up your wealth and then worry about this later when you're actually in retirement?
It's a great question.
What I think about asset location, I think that it is very important, but there's also a reality of how it kind of builds up over time. You know, if you think about the financial order of operations, you can go to moneyguy.com/resources to get the free download. If you go to learn.moneyguy.com, we actually have a deep dive course. But just by the nature of way the government incentivizes tax savings and other things, you're going to find that you will have your emergency reserves, which is of course taxable, and now the interest rates are going up. That's actually generating income again, which is really powerful. That's cool in that aspect. But you're going to find after that, you're going to have tax-free assets, but Roth, but the government's completely restricting the size that you can get in those Roth assets. And then you're going to have a pretty good chunk probably in tax-deferred assets because your employer's contribution is going to be tax-deferred. Also, as you get into higher and higher tax situations, you're going to want to be incentivized to put into that tax-deferred. So you'll look one day and be like, man, my assets are reaching critical mass. I'm getting close to step 6 of the financial order of operations, but I'm noticing like 80% of my money is tax deferred. How do I get more after-tax money? Because I think I want to retire at 50 or 55. How do I get more Roth money? So these things, that's why you will ease into step 7, which is hyperaccumulation. And that's where we get into that 3-bucket strategy that Bo talks about. So I'll kind of let Bo take the rest of it because I just want to go through the timeline of what you're probably going to experience yourself as you are, you know, in your 20s, 30s, and then having more of that critical mass success. Then you'll get to step 7, and I'll let Bo kind of share the rest of the asset location.
Yeah, so Phil, if you're asking about how to build the 3 buckets, that's exactly right. That's the progress. If you're asking about once I have the 3 buckets, what is asset location? Well, asset location is simply what types of investments do I house in which types of accounts? Since they're all treated differently, we know that investments behave differently. So I want to have my ordinary income producers, my more conservative assets inside my pre-tax accounts where I can defer that into the future. I want to have my high flyer, big growth assets held inside of my Roth. And then I want to have things that maybe have a lot of capital appreciation but don't generate a lot of income, or perhaps they have a lot of qualified income and capital gains that they distribute. I want to hold that in my after-tax account. And so Phil's question was, hey, how much does that matter? Well, Brian already sort of said, you got to be at a certain place in your financial journey where it makes sense to focus on asset location, meaning you've hit the critical mass where it makes sense to begin building those 3 buckets. The answer to how much does it matter, it can actually be sort of wild. I want you to do this illustration. If you know how to use a financial calculator, I just want you to go make up a number, put it in there, and I want you to play with your rate of returns. And let's say that you use an 8% rate of return. And then I just want you to very casually do the same calculation, same numbers, but make it an 8.5% rate of return. Just adjust the rate of return a little bit and compound that over 10, 15, 20, 25 years, because asset location is not going to change your overall investment strategy. It's not going to wildly cause you to succeed or to fail, but very small adjustments, very small optimizations along your investment path can have huge impacts over the long term. So it's not like, oh, you know, I made 8% this year in my portfolio, but then I asset located and I made 19.5%. That's not the way that it works. But it can optimize what you're doing by decreasing the tax drag available in your portfolio and ultimately increasing the true amount of dollars you keep in your army of dollar bills over the long term.
I'll put some relative, the materiality of the decision making is that if you're even in a modest income situation, more than likely the tax drag might be 25%.
Sure, yeah.
So 25%, if you think about in terms of the example Bo was giving, if you made, and I'll just keep it easy, 10%, you could quickly see that we're talking about that you would have to play with the time value of money of like an 8% versus a 10%. Sure. Type analysis. So you'd have a 2% drag there to a 2.5% tax drag. Now think somebody who's in the tippity top income tax bracket, you depend upon which state you live in, very much the tax drag now could be 50%. So if you think about in those terms, you're staying 10%. Now you're looking at this could have a 5% tax impact on your rate of return. Yes, it has a huge impact, especially the more your income goes up. Look, there are entire real estate developments that market off of the tax rate in the state of California versus the tax rates in the state of Texas and Tennessee, because they know there are people in high enough income situations that you can literally pay for an entire house off of the tax savings.
Yep.
So without a doubt, taxes do have a dramatic impact in your assets and the rates of returns and what you get to keep. So pay attention to it. So to answer your question, Phil, in a very short way, yes, the 3-bucket strategy matters because taxes matter substantially to your long-term success, especially when you spread out that timeline over the long term.
Love it.